Recent data and developments have clearly highlighted the need for the FOMC to show a deft hand with policy in 2022, to fend off inflation risks while sustaining activity growth at or above trend. Reflecting on recent activity data, most notably the strength of jobs growth at a time of maximum employment, it is clear the US economy's health is robust enough to withstand a sudden, material tightening of financial conditions. Inflation data also argues for such a course. Headline annual CPI inflation printed at 7.5% in January and is expected to strengthen further in February before turning lower. 1 year ahead, consumer inflation expectations are also elevated, the University of Michigan's measure printing near 5% in February, almost twice its decade average. Note also, to this established inflation pulse, effect on energy prices of current geopolitical tensions surrounding Russia and Ukraine is a clear risk to reported inflation and expectations, the latter potentially having consequences for wage growth. 3 weeks out from the March FOMC, we have therefore decided to refine our federal funds rate view, adding one further 25 basis point hike at the May meeting to our existing near-term call of a 25 basis point hike at both the March and June meetings. While certainly a much more aggressive start to the rate hiking cycle than 2015 and 2016, when only a single hike was seen each year, it is appropriate given the starting point for policy and the current rate of inflation. In June 2022, after 3 rate hikes, adjusting for inflation, the Fed funds rate out to the 10-year yield will remain materially below zero and therefore highly accommodative. Financial conditions on a nominal and real basis will change materially in the second half of this year. By then, the inflation pulse is expected to have slowed to 2.8% on a 6-month annualized basis, as the 10-year yield rises above 2.3% on its way to 2.5% in Q4. Underlying this 10-year forecast is a series of quarterly hikes in the Fed funds rate, from 0.875% in June to 1.375% in December 22 and 1.875% in June 2023, as well as the beginning of a sizable reduction in the balance sheet, adding considerable uncertainty to the outlook into 2023. Whereas the FOMC held off on commencing balance sheet reduction until late in the 3rd year of the 2015 to 2018 rate hike cycle, in this instance we believe the FOMC will start that process around the time of the 2nd and 3rd hikes, in May and June 2022. Further, risks around financial stability and inflation warrant the program accelerating as quickly as conditions allow. While remaining passive in nature, this program could still see around $1 trillion of runoff per calendar year once at full pace until the new normal level for the balance sheet is found. Note, it is not only term interest rates that will be impacted, but potentially credit spreads and sentiment surrounding lending and borrowing. Another key factor justifying a quarterly pace of hikes from July 2022 and now historically modest 1.875% forecast peak for the federal funds rate in 2023 is momentum in wages adjusted for inflation. On an employment cost index basis, we forecast nominal wage growth of 4% in 2022 and 3% in 2023. Given our expectations for inflation, it is not until the latter part of 2023 that real wages will see sustainable growth and may form a base for persistent demand-driven inflation, long after supply-side pressures have receded. As highlighted by recent readings of consumer sentiment, there is a material risk that consumption could lose its momentum and cut off growth and inflation ahead of our forecast peak for the federal funds rate in June 2023. However, there is also the possibility that wage gains will sustain a stronger pace through 22 and 23 and add underlying inflation pressures while the supply side is still a concern. These are the 2 key risks we will continue to monitor. We'll see you next time.